All right, here's why I hate to do this to you. We're going to redo the first year of finance class in about an hour. Yeah.
I'm the only one that's excited for that.
Then we'll add exchange rates. Then we'll add exchange rates to it and try to value international projects. All right. I was thinking about mixing it up a little bit from the slides, and that is, I was thinking about going. First, I want to show you the assignment to figure out what you're actually going to be doing over the next week, besides the new case study. And then I was going to show you the last example I have in this slide and go through how I did that. I might try to do that, because I like to go through that example first and then go, whoa, you okay? Scared me. So let's, you don't have this yet, but let me show you an idea what the assignment is for next week. It's just a spreadsheet, and the spreadsheet has 11 team-based, and the spreadsheet has 11 questions. All right, let me give you an idea what they are, and I'm gonna look at it one more time before I submit it today around noon. So here's an exchange rate. Here's the USD CHF. You have to recognize that that is the Swiss price of $1, just because you saw Swiss being the second currency code, and see that that's 1025, and be able to convert 100 francs to dollars. Here's a yen exchange rate, 110 yen per dollar, doing a conversion. Here is euro exchange rate, a yen exchange rate, and you're going to do a cross rate, converting euros to yens. Here is a exchange rate. The yuan went from 6.4 to 6.6. What is the appreciation of the yuan? So you have to understand new minus old, all that kind of stuff.
So you see the formula, and we get points for the formula as well as for the actual correct answer, or do you only get correct or wrong points?
You will get partial credit.
So it's more than to show you the formula because
Oh, definitely put formulas in there. Yes, yes. Don't put numbers in there. That'd be best. Especially since most of them I have the inputs here, so it'd be best just to link it. Here's like a Big Mac index problem. It costs 28 yuan to buy a latte and $3.50 to buy a latte. What is the exchange rate in which there's no arbitrage in lattes? Pretty simple stuff, right? Here's inflation in 2 countries. What's the exchange rate today or next year? What's the expected appreciation? Here's a spot price for the Czech crown and negative 816.60 points. What's the forward price? So you have to know how to line that up. 8. By the way, this is recording, so it'll give you a nice kind of prep. If you look at lecture 3, you'll see the prep for this, so it'll help you. All right. Here's Australian interest rate, Japanese interest rate. What's the expected appreciation of the Aussie and of the yen? All right, and then these last 3 problems are related to this last section. So, global WACC. So Walmart's considering a purchase of a store in Brazil, and they're going to have a financing at a DDE ratio, that's debt to equity for those of you who haven't forgotten, of 1.0. Walmart needs a discount rate. In other words, if you want to take the NPV of a project, you need a discount rate, right? And one thing we talked about a year ago was the discount rate should reflect the risk of the project. I would assume that projects in Brazil are riskier than projects in the U.S. for a U.S.-based firm. So the question is, why would the discount rate be, or what would the discount rate be in Brazil versus the U.S.? Now, there's 2 things going on in this problem. The Brazil will be financed with a higher DDE ratio than the corporation itself. So the new project's going to have more debt, but the new project's also going to be in Brazil. So we're going to take both those factors and calculate a new weighted average cost of capital. Does that burn in your ears? WACC?
Burns a lot of places.
Burns a lot, hurts. So what you're going to do is here's Walmart's corporation data. They have a equity beta of 0.8, a tax rate of 25%, a DD ratio of 0.2, and their cost of debt is 5%. In Brazil, it's going to be the same tax rate, more debt, and a higher borrowing rate. So the question is, you're going to actually calculate the WACC for Walmart, which we'll walk through WACC formula. That's pretty, remember, it wasn't that bad, right? The WACC, you had the cost of equity and the cost of debt, and the debt percent and the equity percent. And we had that little model called CAPM, risk-free rate plus beta times market risk premium. So you're going to calculate the WACC for Walmart, which I think is just following a formula. And then you're going to calculate the WACC for that Brazilian project in Walmart. What you're going to do is say, okay, the new store in Brazil is going to have roughly the same business risk as Walmart, So we're going to use Walmart's beta, but it's going to have less debt. So this may ring some ears. We're going to unlever their Walmart's beta by Walmart's DD ratio and see what Walmart's beta would be, their sensitivity to the stock market if they had less and they had no debt. And then you're going to relever the beta based on the new DD ratio. And we're going to add an extra 4.5% to the WACC because Brazilian interest rates are higher than US interest rates, and that must be a proxy for how much riskier it is to be in Brazil. That's this problem. All right, I'm going to slow down and do an example of this in a bit, but I wanted this to be on the recording. Does that help? Okay, so that's what you're going to do for this problem. This is a cash flow problem. I'm going to receive I'm going to pay 1,200 Brazilian real, or reais. I guess I normally say reais, right?
Real or reais?
Reais. All right. So what should I say? Real? What's it?
Yeah.
All right. So I'm going to pay 1,200 real today, and then I'm going to receive 100 real next year. So T equals 1. Now it's confusing. I always regret using Brazilian currency because someone's like, "Oh, what's real? Does that mean like nominal?" No, that's actual real currency. And then those cash flows are going to grow at 20% a year. So that's going to go from 100 to 120 to even more, 120 times 1 plus the growth rate. However, at some point in year 6, that cash flow is going to grow at 6% forever, and you're going to have a growth perpetuity. You're going to add the first 5 years of cash flows plus the cash flows from year 6 to infinity, and that's going to be, and plus today's cash flow, and you're going to calculate an NPV of that series of cash flows, discounted at 15%. All right. Now the trick is this is in real. Every NPV has to be in dollars. So I need to convert these convert these currencies to dollars. But all you're given is the current spot rate. Spot rate is exchange rate for today's dollars, right? So it's for trading currencies today. That's quoted at 4.1 real per dollar. However, you're given interest rates in the two economies. So I'll use that to forecast the 1 year, 2 year, 3 year, 4 year, 5 year exchange rates. That's what I'll use to convert these cash flows back to dollars. All right, we're going to do an example in a little bit and then apply a growth perpetuity. And then I kind of gave you a hard question.
Yeah.
Ingersoll Rand's going to build a distribution center in Japan that's going to allow it to increase sales to China and Japan. It's going to build it in, let me change that. This is why I haven't finished this yet. I changed this last night. You're going to build it in China. It's going to allow it to, let me see, make sure, yeah, because the cost today is $450,000. So they're going to build a distribution center in China to generate additional sales in China and Japan. It's going to be, today the cost is going to be $450,000. I'll just make that a negative. 450,000 Chinese yuan. That's today's Capex. That's going to be depreciated over 15 years. Oh my God, it's accounting. All right, so you're going to depreciate that expense over 15 years. So 450,000 divided by 15, that's going to be your annual depreciation. It's going to be worth nothing in 15 years. No salvage value. And then they're going to generate yen and yuan revenues for the next 15 years, 150,000 yen per year and 90,000 yuan per year. And also have some Chinese operational expenses. There's also going to be some working capital equal to 10% of sales. And that business is going to be worth 15 times EBITDA in year 15. So what you're needing to do is calculate the cash flows for 15 years by getting sales minus operational expenditures, converting them back to US dollars. Convert the Capex to US dollars and get the depreciation. That's going to give you EBIT. And then take out the taxes. That's going to give you after-tax EBIT. And I'll go over the lecture in a minute. One thing you take away from first year's classes is free cash flows, or EBIT after tax. Add back depreciation, subtract Capex, and subtract any changes in working capital. You make those adjustments and calculate the NPV. I'm going to work through an example in a minute, but I want to give you a high level what you need to get out of this lecture so you can solve these 3 questions. Okay? I also give you two exchange rates, the Chinese exchange rate and the Japanese exchange rate, and I give you interest rates in all three countries so you can get exchange rates to convert all the cash flows.
Negative interest rate in Japan.
Yeah. All right. So these are the three problems. One is calculating a WACC for a foreign investment that has different debt. One is just taking cash flows and calculating a growth perpetuity and taking the present value of those. And one is a little nastier. We have to actually get revenues and expenses, convert them back to dollars, and get to cash flows. All right? Am I killing you?
Yes. Yeah.
All right.
Absolutely. The deal here, man.
I hear at Temple they just give you the first problem. Is that where you want it to go?
Yeah.
Is that where you want it to go? Is that where you want it to go?
We do like your guest speakers.
Oh, that's fair. Oh, it's because they have nothing to say. That's a good guess. All right. Oh my God, this is like my last slide. Oh yeah.
You're gonna put this on your tombstone, man.
Actually, it's a tattoo on my shoulder. It's my tattoo. Wouldn't that be great? All right. This is every formula you ever need in finance. All right. Here's what you're going to do to calculate free cash flows. You're going to calculate revenue minus expenses minus depreciation. You're going to get to earnings before interest and tax. You're going to take out taxes. You're then going to add back depreciation because depreciation is a fake expense to get to cash flow. You're going to subtract any changes in working capital because building up of inventories and things like that are actually a cost of cash to the business. And then you're going to subtract any Capex or add any salvage. There's no salvage in this problem. That'll get you to free cash flows of the firm. Those are the only cash flows you should ever evaluate for a business. That's the actual cash coming in and out of a business. It's not profits, it's cash. You'll then take an NPV of all future cash flows. We can't just add cash flows across time, right? $1 tomorrow or $1 a year from now is worth less than $1 today, and $1 15 years from now is certainly worth less than $1 today. So we can't just add up cash flows, take a sum. We want to take an NPV, which then discounts the cash flows at some interest rate that accounts for the risk of the project. So the NPV will be whatever the initial cash flow is today, plus all the NPV of all the future cash flows, which get discounted at some discount rate. Does that seem familiar?
You're recording this.
Oh, yeah. We then, at some point, so I give you two examples. If it's a finite life project, meaning the project will only last 5 years, I will take the NPV of those 5 years of cash flows. However, many projects are ongoing concerns. In other words, we're going to do 5 years of estimation of cash flows, and then we say, okay, then the business is worth 10 times EBITDA, or maybe it'll grow at 2% forever. That's our only two choices. Some kind of a multiple, a cash flow multiple, or some growth perpetuity takes the present value of a future stream that goes on forever. So if it's an ongoing concern, you either will add probably this, some EBITDA multiple times the EBITDA, or you'll take the cash flow in the last year over K minus G, R minus G, which is a growth perpetuity formula, and discount that back to the present. We'll do an example in a little bit. So this is how we get the cash flows. And the only question is, then, how do we get the discount rate? Well, I'm going to use WACC. This is my WACC formula. WACC is your whatever rate of return that your equity holders demand. Where do I get that? I get that from the standard capital asset pricing model, CAPM. CAPM is pretty much the model everyone uses and says that every equity holder should demand the risk-free rate plus a compensation for risk, where that risk measure is called beta, which is just the sensitivity to the stock market. So you take a beta times the expected return of the stock market over the bond market plus risk-free rate, that gives you the cost of equity. Yeah.
Are your YouTubes from the first class still published on campus?
They should be still there, yeah. But I don't know if you'll need them, though. But if you need them, they're there.
I would be surprised if I didn't. But...
No, I don't. I'll check the usage this week. I'll be interested. All right, and then so that's my cost of equity times a percentage of equity, after-tax cost of debt times a percentage of debt. And the only thing I'm going to do for a foreign project for this class is I'm going to add a sovereign risk premium. If interest rates in another country are higher than the U.S., I'll just assume that must be due to their riskiness, and I'll add that to the WACC. That's a kind of a cheap way to account for country risk. Yeah. So if 10-year Brazilian sovereign rates are 6% and ours are 4%, I'll just take 2 and call that the sovereign risk premium.
That's the rate.
That's the sovereign risk premium. All right. So that's the first course we had together, in which we spent 26 hours or 24 hours together. All right. I know you're all rolling your eyes. I love that feeling, by the way. What I want to do is I can walk through a few, I want to go through the slides, maybe just show you what's there. And then I want to dive into a spreadsheet and show you a problem that looks a lot like the problems you're going to have. Okay? Does that sound all right? Because I want to really get into that last spreadsheet, and I hate to rush that last spreadsheet. I'd rather rush the slides. So let us jump to the, do you have a spreadsheet, right? That was posted, topic file, end file, or topic 3. Just an end file. Yeah, you guys are much beyond start files. You're... All right. All right, I'll give you a minute to grab this file. I want to crawl through this.
Which tab are you?
I'm on, global NPV. Global NPV. This is actually the other stuff I gave you in the other course, but here's the new one, global NPV. Anyone need a minute?
Yeah.
All right, I'll give you a minute. Okay. Lecture number 3 end file, spreadsheet, global NPV worksheet, the one we're going to use. I know I just scared you, but we're going to work through this problem. And I want everyone to leave understanding how this was done. And I think it's going to help you get done to 3 assignments and help you understand how to evaluate foreign investments, ultimately. End file, global NPV. Global NPV is the worksheet. See where I'm moving around right there? Anyone need another minute? You got it.
Yes.
Global, yeah, number 3 end file. All right, so here's a little example I made up last week. Google establishes a software lab in Tel Aviv, Israel, to sell services in Europe. So how would Google, a US-based firm, evaluate a project in Tel Aviv, and which has costs in shekel and some revenues in euro? So here's what's given. Let's start here. The revenues, it's going to take 2 years to get going. The revenues are from years 2 to 5 are 800,000 euro. They're millions, but don't worry about that. 800,000 euro. The labor costs first year are 700,000 shekels. So that's the engineers we're hiring there. Labor costs year 2 to 5 is we get fully up to speed, and it's 1.6 million shekels a year, labor costs. The lease expense is 800,000. All right, so that's just another operational expenditure. We're going to buy $250,000 worth of equipment, which is going to be depreciated over 7 years. I'm sorry, the project's only going to last 5 years, but the equipment's going to depreciate over 7 years. And the equipment's worth $50,000 at the end of the 5th year. The net working capital percent of revenue is 10%. U.S. tax rate is 25%. We'll just stop there for now. So if I want to calculate the cash flows of a foreign venture, the first thing I want to focus on is getting all the dollars, all the currencies back to dollars. So my revenue, we'll start top line of the income statement. My revenue is 800,000 euros 2 years from now. Again, it's a lab in Tel Aviv that services Europe. So 800,000 euros. I'm only given the spot price of the euro is $1.10. However, I'm given interest rates in 3 countries. Well, economies, Euro, Israel, and the US. So I start with the current exchange rate of $1.10. You okay? I then use my interest rate parity formula. $1.10 times 1 plus the US interest rate divided by 1 plus the euro interest rate. Looks like the euro is going to appreciate by about well, what's that, from $1.10 to $1, it's not changing much. It's about 0.5% per year it's going up, which makes sense because euro has 2% lower, or 0.5% lower interest rates. So this is my model to forecast the euro, which is that interest rate parity formula. You okay? By the way, I do the same thing for the shekel. The shekel is 3.5 shekel per dollar. Take that spot rate and multiply times 1 plus the shekel interest rate over the dollar interest rate. If it's shekel over dollar exchange rate, it's shekel over dollar interest rates. If it's dollar over euro exchange rate, it's dollar over euro interest rates. So notice a slight difference that the dollar's in the bottom here, the dollar's in the top up here. So now I have forecasted exchange rates for the next 5 years. You okay so far? So I'm going to convert that 800,000 euros using those future exchange rates, not today's exchange rate. Can I help anyone so far? All right. Just focusing on cash flows. I then have a lease expense in Israel of 800,000 shekels per year. I'm going to multiply times 1 over the shekel exchange rate. Shekels times dollar over shekels equals dollars. But I need to flip this exchange rate. So in dollars, it's going to cost me 226,000, 224,000, and so on. I didn't show any growth in costs or revenues because it would just kind of superficially complicate things. I just kind of kept it. Yeah.
Your top line revenue, so G10, that is the top line revenue in euros.
Yes.
Your lease expenses then.
Well, no, this converts it to dollars.
That converts it to dollars.
Yeah.
The spot rate, forward spot rate, for the forward rate of the exchange.
So
Okay.
it's 800,000 times $1 per euro exchange rate. So that's what converts it to dollars.
Okay.
I'm multiplying times 1.1108, which is the forecasted exchange rate in 2 years. However, with this one, this is in shekel, right? So I need to multiply shekel times $1 over shekel exchange rate, but I'm given a shekel over dollar exchange rate, so I got to flip it. So now I have that. And I did the same thing with labor, just converting everything back to dollars. All right, the first 3 lines weren't that bad, were they?
No.
You okay? Just forecasting exchange rates and converting all cash flows back to dollars. All right, I'll lose you pretty soon, don't worry. All right, let's talk about Capex. I want to skip. All right, so let's highlight things that we've nailed. Have we nailed this? We good with that?
Yeah.
All right, let's nail this number right here. What's the Capex today? Well, I'm going to, where'd that go? E27. Oh. Where did I put that? E27. Oh, I'm sorry. I just wasn't showing up on my computer. All right. So I'm going to buy, well, it's just a link to this number here. I'm going to buy $250,000 worth of equipment today, pay dollars, and ship it over there. So my equipment cost today is $250,000, but I'm going to depreciate $250,000 over 7 years. So it's just 250 divided by 7. But I'm only going to forecast this out to 5 years just because I said the project's going to be kind of closed down at the end of the 5th year. So I'm going to kind of stop it there. So you okay with depreciation? Just 250 divided by 15? I'm sorry, divided by 7? Are you okay with that? And I know I'm going to depreciate it over 7 years, but I'm going to wind up selling it at the end of 5. I want to do a 5-year project. Yeah, all right, we good with that?
Yes.
Oh my God, we are getting so much progress. This is great. Yeah. Yeah, we're just going to use straight line, just for simplicity. Yeah. I mean, otherwise I have to give you a percent every year other than, yeah. All right. All right, here's an easy one. I finally got 3 easy lines here. EBIT. Are you okay if I take revenues minus expenses? You okay with that? All right, so that's EBIT, earnings before interest and tax. Done. Tax. Okay, there's a 25% tax rate. You okay with that? See, I'm comforting. Isn't this comforting? Isn't this comforting? All right.
It's like an old friend.
It is like an old friend. Okay.
But is your tax rate gonna, you're not repatriating, you're saying?
No, I'm going to get to that in a minute. That's the bottom line. I'm feeling better about this. I'm feeling better about this. Okay, so all I've done so far is just get revenues, expenses, convert them back to dollars, and depreciate some $250,000 equipment. Okay, to get from EBIT after tax to free cash flows of the firm, I need to make 3 adjustments. Add back depreciation, subtract the change in net working capital, and subtract Capex or add any salvage value at the end. Those are the 3 adjustments we always make to go from accounting, called it net operating profit, EBIT after tax, and get to free cash flows. Is it okay I just add the depreciation back? Yeah. Okay. All right. I think we've nailed this so far. Okay. And we're good with this number, so let's talk about just these numbers. Net working capital has been defined as 10% of revenues. So I have a little line item down here that's called net working capital, and it's simply 10% of revenue. So think of this as inventory that's being held. So it looks like going from year 1 to 2, you build up your inventory by $88,000. That's going to cost money. That shows up here as subtraction of the change in net working capital. So here's where we build up the inventory. Except this is a finite life project. Notice what I've done here. We're under net working capital. I put in a 0. So at the end of this 5 years, let's just assume we sell off all the inventory. And it goes to 0. We did this, you probably remember the last day in our last class. So think of this as building up inventory, builds up a little more, and then you flush it all out. You sell it all off. That's subtracting, I put a negative sign in there, subtracting the change in net working capital. Because inventory is a cost. It's a cost of cash, comes out of your pocket. But it's not in the income statement, so you have to account for it somewhere. All right, last tough line. Actually, tough number. It's a number that kills people, though. First one's okay. So I need to subtract Capex and add any salvage if there is any. So I'm going to subtract Capex today. You paid that today. Here we go with that. After-tax salvage. Oh, my God. You probably have nightmares about this after-tax salvage formula. It's, where's my lecture? It's this nasty little formula, so I'm just going to get this so it's in the record, the YouTube record. It's this little thing right here. The after-tax salvage is whatever you sell for, salvage, minus the tax rate times the salvage minus the net book value. So it's this. It's whatever you sell it for minus the tax that's due to the IRS. The IRS says, well, what's tax is the difference between what you sell it for versus what you say it's worth in your financial statements. So.
But if that difference is less than 0, then we don't get a tax back, do we?
Yes, you do.
Yes, you can have loss.
You can have this be more. So this, I sell the equipment back at the end of 5 years for $50,000. So I get a check for $50,000 when I sell it. The question is, what is the tax bill on that transaction? Well, I need to calculate the net book value of the computer. The net book value, the day I buy it, it's worth $250. By the end of the next year, I subtract 1 year's depreciation. End of the first year, the net book value is $214. I then subtract another year's depreciation, another. According to the IRS, that computer is worth $71,000. You sold it for $50,000. So you're actually getting a little tax rebate because the IRS is telling you, oh, I'm sorry, you took a loss on that. Let me let you offset some other gains. But it's just a formula, right? I got $50,000 and I wound up getting a tax rebate of $5,000, which is the tax rate times $50,000 minus 71,000. So the IRS says, oh, you poor thing, you lost 19,000 on that, or yeah, 19,000, well, no, 71 minus 50, $21,000 on that. I'm sorry, you can use that to offset other income. So the after-tax salvage is actually 55 and not 50. I only know, I won't make that one yellow because I'm not even gonna pretend that was easy. But that's basically this 50,000, what you sell it for, and the tax effect.
So does that mean like 5,357 is your tax rebate coming back?
Yes, 5,000 is basically the tax rebate, or the reduction in taxes in other areas of your business, really. Because you get to you basically, if you think of the tax bill, you're basically be able to reduce your taxable income by 19,000 or 21,000, which is going to reduce your overall tax bill by 5,000. Okay. All right, I won't make that yellow. You just have to go back and take a look at that. Yeah, Michael.
So I don't pay any taxes in Israel, even though all the activity, the economic activity is taking place in Israel.
We'll
pay taxes when you set up depreciation.
For these. I'm sorry. Go start over.
In the years 1 through 4, when you took the depreciation expense, you actually pay taxes down. So you actually kind of get your refund for what you overpaid.
So the way I'm going to model it, and most people model it, is if you're doing business abroad, there are taxes abroad and taxes in the U.S. And when you bring the money back to the States, you might get taxed even more, the difference between the two tax rates in the two countries. All right, but let me talk to that in a little bit. We'll just pretend that so far there's no Israeli tax consideration just yet. All right, so I now have free cash flows. This is what's coming in and out of my pocket, or in and out of Google's pocket. You okay? Any questions about any number above? I really like to spend time on any number above.
I just had a general question. Would you add the 55,000 back, like the 5,357, if you were operating in a net loss that year? Would you add that back if you truly wouldn't get?
So great question. If you didn't have other income to shield, well, it gets more complicated than that, because if you've had any gains over the last 3 years, you can do a carry back type of what's it called, loss carry forward. So as long as you've been profitable, you can use that to pay less taxes this year. So, but if you haven't been profitable in 3 years and you're not profitable this year, so you're right. But we'll just assume that's it. All right. So then I added an extra line here. Let's just pretend you have to pay an extra 5% due to the differences in Israeli versus U.S. taxes when you bring it back home. We'll call it repatriation tax, the act of repatriating earnings back to the U.S. And how it's going to work is whenever you have a positive inflow from the U.S. business or the Israeli arm back to the States, if that number is a positive cash flow back to the States, we'll tax it at 5%. That's how we're going to model it. All right, I'm not going to get the specifics of international tax law, but you've determined that when you bring the money back to the States, you're going to pay an extra 5%. So I have a little if-then statement. If this is negative, don't do anything. If it's positive, take 5%. That's all this statement is. So I'm just taking 5% of 82, 5% of 178, but I'm not having any kind of tax rebate for losses. So that is just simply an extra tax that accounts for the differences in international taxes. And I just want to leave it at that because I am not an international tax. I wouldn't even say I'm an expert. I have no international tax knowledge. I just know when you bring money from foreign ventures back to the States, you're often taxed an additional rate.
And so these numbers are already in future net present value.
No, they're just free cash flows. 0, 1, 2, 3, 4, 5. Net present value means today. All right, present value. All right. So this is taking out my taxes. I'm going to assume this business is shut down. So the business is shut down, so there's no terminal value, there's no growth perpetuity, there's no EBITDA multiple. So I'm just going to shut down the business. So these are the final cash flows, which are simply revenue and expenses converted back using forecasted exchange rates. Yeah.
I think you have told, but I probably forgot the net working capital in the 5th year. Why is it zero?
It's an assumption. We're assuming that this business at the end of 5th year is shut down. It's a finite life project, therefore all the inventory is sold off, so net working capital goes to 0. If I say that this project is an ongoing concern, meaning that it's going to go on forever, but I'm just using a 5-year estimation window, I'll look at an example a little bit, then I would just not zero it out. So this is liquidating everything. It's liquidating inventory at the end of the 5th year.
But you're assuming that you can actually liquidate the inventory without any loss.
Absolutely. If I was doing, again, so there's always choices of kind of complicating factors. But if you're right, if I was doing this for a living, I'd have one extra factor, is when I liquidate inventory, what loss do I take? Do I take 20% off? So I'd probably do that. But then the only reason I really don't want to do that, because that's not that hard to model, is there's tax implications of that. So I'm like, I don't want to touch it. But you're right. You could make an assumption that on liquidation of inventory, you have to sell everything at a 20% haircut or something like that, or reduction. But yeah, you're exactly right. All right. So then I just take my NPV, discounted at some interest rate. And I'll just say that's 7.8%.
The next thing, in Europe, we have what's called value-added tax.
Mm-hmm.
So if I produce something and take input and then output,
Yep.
I differentiate the added value, and I have to pay tax on that.
Yeah, that would have to probably be included in the revenues or some. Yeah, so we'd have to account for that. I just want to punt on that for now and say a tax account. Your tax person has kind of told you the tax impact. Yeah, but yeah, you're right. So if it's a sales tax, maybe it's just included, netted out of the revenue. All right, so NPV, remember the NPV formula, you actually can only put the future cash flows. So you do NPV, put in a discount rate, highlight all your future cash flows, but then you have to go back and add the first cash flow, which is the negative 250. You remember that kind of adjustment? The NPV function doesn't work on the first cash flow. So this project generates an NPV of $18,000, has an IRR of 8.9%. IRR, you put in all the cash flows. All right, so that is as complicated as a model gets. The three I give you are little, different pieces of this. The only thing I want to talk about for 10 minutes is how I got the discount rate. But please ask any questions on cash flows. Again, so I'll just do the 1-minute version. I got euro revenues. I brought them back to the US using interest rate parity forecasted exchange rates. I got shekel expenses. I brought them back to the US using shekel dollar exchange rates using interest rate parity. Depreciation, it's a US purchase, so I just took $250,000 divided by 7 years. That's my expense. That gave me EBIT. I then got EBIT after tax. I added back depreciation. I then subtracted the change in net working capital. Think of it as the buildup of inventory, where I kind of kept track of the balance sheet item right here, where it's just 10% of sales. So I subtract minus the change in net working capital. That's why it spikes when it goes from 0 to 88,000, and then when it goes from 89,000 to 0, it comes back. I then subtract the Capex, the actual cash purchase of that machinery, the computers. However, at the end of 5th year, they're worth $71,000. You sold them for $50,000, so you got the after-tax value. I then added a little magical 5% when you brought the money back to the States to account for the differences in tax rates or some kind of taxes for international transactions, and that gave me free cash flows, and I calculated the NPV. That is the first-year class besides dealing with WACC and the discount rate. Can I help anyone with any of these numbers here? Because I want to spend about 10 minutes talking about this, which will help you do the other problem.
The terminal value is just an assumption kind of built into the business is going to have a value at the end.
Yeah, so actually remind me after I do the 10 minutes,
yeah.
I want to do the 2 possible solutions to having an ongoing concern. I want to try to put 2 things in here. So I'm going to make that for now. Well, we can do that. Let's do that now because it's cash flows. All right. Any questions so far? Not any questions so far. Anything that's really killing you that you think I can help you with?
Is there a way to, so when you essentially dollarize your cash flow before you do anything else, is there a way to spot check the intuition of what you come up with
for these?
Yeah.
All right. Yeah, that's a great question. All right. Eric, using interest rate parity model.
Right.
These are proxies for inflation rates. So if I look at this, what this tells me is the euro or US has more inflation than Euroland. Euro has less inflation. So who's expected to appreciate in this future world? Euro's expected to appreciate. Is it appreciating? Yes, it's getting more expensive. It works. So I didn't flip the formulas the wrong way. Israel has the highest inflation. They're going to devalue, right? So this is the shekel price of $1.
So is
The
that,
dollar is appreciating. Ah, that makes sense. The shekel's gone from 1/3.5 to 1/353. It's depreciating. That's how I'd check it.
so if I can just like say that in words from my brain, the the way to spot check this is to say like, does the projected change in an interest rate show up in the appreciation or depreciation of these currencies?
Yeah, so spot check FX rate forecast. Currency with higher
Yeah,
interest rate should devalue.
devalue. Okay.
Check, check.
Yep.
Got it?
Real
Good.
Great.
interest rate.
Yeah.
No, nominal interest rate. We haven't talked anything about real interest rates. We're actually never, I don't think we're going to talk about real interest. I might add it for one slide
So
next week.
inflation is irrelevant.
It is. Well, these are not, everything here is nominal.
But the forward rates are not affected by predicted or expected inflation.
They are, but we're using interest rates as a proxy for inflation.
So in other words, Michael, that anybody who's setting their interest rates and policies, those people understand all the stuff that's focused on us, and they're building that into the interest rate model. Because remember, the nominal interest rates are real interest rates plus the inflation, right? And so they closely approximate them.
Yeah, and in the real world, there are no real interest rates, right? We observe nominal interest rates. You've never observed a real interest rate in your life. You get a bank loan, you get a mortgage, everything's real. You buy a bond, everything's nominal. Real is only a construct by economists to try to think about real returns adjusted. So the world is nominal. And sometimes it's important to think about real, but not yet. Not in this part of the course. All right. So I do want to do two things before I move on to this, because this will help you on the problems. This is a finite life project. In other words, 5 years, we fire everyone, sell off the inventory, and call it a day. When you do that, there's no terminal value. In other words, this is the last cash flow. You also liquidate the inventory. There's nothing left. But what if I say, oh, at the end of the 5th year, that we just let the business run. So, inventory is going to stay out there. You see what I just did? I just had inventory growing with sales again. Now, inventory, it continues to grow as a cost of cash. So that's the first thing I did, all right? I didn't liquidate the business. We would also probably take that out. We're not going to sell the equipment. We'll just continue to depreciate it. Right? We're not selling off the business. Again, what we're doing is we're estimating the business over 5 years, and then we're just going to stop. We're just going to use that window to forecast cash flows, but we're not going to sell the equipment. So I'd probably do that if I was going to consider this an ongoing concern. However, if it's an ongoing concern, the cash flows are going to continue into year 6, 7, 8, 9, 10, into infinity maybe, right? So the question is, if I do that, I need to somehow account. This is a terrible color for looking, so let me change this to blue. That's a terrible color too. I need to account for this cash flow. What is the business worth 5 years from now if it's an ongoing concern? There are two ways to do it. One, just make, on average, firms my industry sell for 7 times EBITDA. So I could just say 7 times, I just need to get to EBITDA. I'll have to do a little trick here. Revenue minus operational expenditures. That's earnings before interest, tax, and depreciation. So I just didn't take the depreciation. So EBITDA is just 900 minus 200 minus 400. So the business must be worth $1.7 million in 5 years. another way of thinking about that is I run the business for 5 years and then sell it to somebody else, and they're willing to pay me $1.7 million. That's the way I think about it. It's a way of trying to capture the value of an ongoing concern, but not do a spreadsheet with an infinite number of columns, because that would take a long time to do that. I'll just pretend I sell the business off for 7 times EBITDA, or I just pretend it's worth 7 times EBITDA, so I'll just finish the valuation in year 5, even though it goes on forever. That's why we call it a terminal value. What's it worth at the end of my fixed finite estimation window? So this would be a way of determining the NPV and IRR of this infinite life project, ongoing concern. I have working capital just continuing. I don't sell off my equipment, and I have to come up with some value for the business from year 6 to infinity.
But hang on, you didn't pay for getting it back to the US. You still have to pay the repatriation tax on it.
That's being in this particular case, I'm assuming that the repatriation is after, but you could easily make the assumption that, well, I hate to do this, but you could rearrange these columns that the repatriation tax was before, but I'm not going to do it. All right, so you could take the you could take the 5% off that. That's all. Okay, so you could take the 5% off that. So that's how you handle ongoing concern. There's only one other way to do it, and this is the other, besides this nasty salvage equation, is the one you hated the most, I remember, from the first year. That is, you can either use an EBITDA multiple to come up with a terminal value, or just assume a constant growth rate. Say it grows at 2% forever. Is that all right? So, say my last cash flow is $185,000. And we'll pretend that grows at 2% forever. That'll be my cash flow in year, what, 6, right? Let's assume it grows at 2% forever. That's my cash flow in year 6. I then divide that by my discount rate minus my perpetual growth rate. Any cash flow divided by the discount rate over R minus G is a value of a perpetuity that goes from this year, year 6, till infinity. I then can add that to my year 5 cash flow, and this is the NPV if I assume it grows at 2% forever.
Can you do that equation one more time?
Yeah. I take my year 5 cash flow and grow it by my perpetual growth rate of 2%. Let me make it bigger for the video. I take my year 5 cash flow and multiply times 1.02. That is now my year 6 cash flow. I divide it by R minus G. That then turns that into a perpetuity from year 6 to infinity. And it gives me the value in year 5. I'll just add that to my year 5 cash flow, and I take the NPV of that row.
I almost get confused on this because you're calculating for year 6.
Yeah.
But then you bring to year 5.
Yeah. Just because the formula for the growth perpetuity. So great question. The value of a growth perpetuity is the cash flow in year, I'll say in year T, is the cash flow in year T plus 1 over R minus G. There's no way of making this easy. If I have a cash flow in my numerator of year 6, this formula will tell me the value in year 5. So that's why I took the year 5 cash flow times 1 plus the growth rate. That gave me a year 6 cash flow. When I divide by R minus G, it gives me the value in year 5. That's why I added it to a year 5 cash flow. And you're going to do the same thing on the assignment, so about 7 years or 10 years. All right, so that's how the cash flows work. I give you a, yep.
R again was the inflation rate.
The discount rate, whatever discount rate, usually the WACC, So the R is the discount rate, usually the WACC.
And G would be
Perpetual growth rate of cash flows. What the business will grow at forever. Yeah. All right, so the only thing I want to talk about now for the last 10 minutes. All right, so I know there's a lot, and it's a dumb question to ask, and is anything you don't understand. The toughest parts are thinking about working capital, but I'm going to explicitly tell you whether you liquidate or not. And then thinking about the after-tax salvage to get the cash flows. And then it's a matter of getting this number here. If it's an ongoing concern, in other words, it's not a finite life project, it's going to go on forever, how to estimate the value of all the future cash flows. And in my world, and all the modeling I've done, it's either an EBITDA multiple, 5 to 10 times EBITDA, or it's this formula right here. And that's how you capture it. Usually I'll do it both ways, and then I'll try to decide which one I feel more comfortable with, or take the average of the two or something like that. All right, so the only question is, how do I get 7.853% as the appropriate discount rate for Google to have a project in Israel? All right. Let me show you what I did. Google has realized there's the average beta on the software services market is 1.2. Remember, any beta greater than 1 is 20% riskier than the overall stock market. So it's a relatively risky business. The average software industry has a DDE ratio of 0.3 and a tax rate of 25%. And I give you a formula, it's on the slides, that if you want to unlever and relever betas, the levered beta is the unlevered beta times 1 plus the after-tax DDE ratio, and the unlevered beta is the levered beta divided by 1 plus the after-tax DDE ratio. So those are my two formulas. So what I'm going to do is I'm going to say, what would the software industry beta be if they had no debt? Well, it'd be safer. It wouldn't be 1.2. It would be 1.2 divided by the after-tax DDE ratio. It would be 0.98. So this now captures the risk of a business venture in software development in which there's no debt. Now this project's going to have a DDE ratio of 0.1. So what I do is I just take that beta and I re-lever it based on the project's DDE ratio. So Google's beta for this project, because they're going to use debt, isn't going to be 0.98. I'm going to have it to be 1.05, just because it has a little more debt. I then plug that into my CAPM formula, U.S. risk-free rate plus that beta times market risk premium. I'm given the cost of debt. I'm given the tax rate. I'm given the project's DDE ratio is 0.1. One other last formula I want to point out on that formula sheet is, hopefully I have it somewhere. Oh, this formula down here. Is it somewhere else? No. When I give you the DDE ratio, okay, that is not, just make sure you get this point. The DDE ratio is not the same as the percentage debt in a firm. D over E is not equal to D over D plus E. However, the DDE ratio over 1 plus the DDE ratio is how I convert DDE to the percentage of debt. That was something we did in the first year lecture. So D over D plus E is equal to the DDE ratio plus over 1 plus the DDE ratio. So how much debt is going to be financed? Well, it's the DDE ratio over 1.1. So it must be 9% debt and 91% equity. I plug that into my WACC formula, where I have, this is my cost of equity for the project using the CAPM rate. Here's my cost of debt. Here's my cost of debt. It's 9% financed with debt. It's 91% financed with equity. I calculate my WACC, and the only difference between the two classes, is I'm going to assume I'm going to add an extra 1% to the WACC because Israel is riskier. And I'll call that my sovereign risk premium. So this is a really hard problem. The three problems I give you are kind of little pieces of it. They only do the cash flow, they only use the discount rate, and one gets a little bit closer to this one. But this is it. This is actually our entire first year class calculating NPVs. And the only reason why it's different for foreign ventures, I need to get things to dollars, and I want to account for the risk by adding the sovereign risk premium to the WACC.
Can you put into the formula for B35? The WACC.
Yeah.
And just for my clarity, so we used to use MRP and we're just replacing that with SRP?
Oh, so great question. So let's talk about that. SRP is sovereign risk premium. In this case, it's the difference between the rate on Israeli bonds versus U.S. bonds. MRP is market risk premium. And that's simply used in the CAPM formula to compute cost of equity. Okay, so sovereign risk premium, I'm just going to add that 1% to my WACC and say that's how I'm going to adjust for the risk of Israel. The market risk premium is what I use to calculate cost of equity. It's the extra premium you get based on the beta. Michael.
The sovereign risk premium includes, it's just a difference between the two rates.
Yeah.
But it includes, in a global picture, a lot of different things.
Oh,
What we
absolutely.
expect to be in growth, how the demographics may change in the country, when the next war starts, if the president...
Exactly. Yeah. So it is highly criticized that this difference between interest rates on U.S. bonds versus Israeli bonds, what they actually reflect. It could be liquidity, it could be default risk, it could be terrorism risk, it could be inflation rates. A big assumption is we're just going to use that as a proxy for the risk of operating that business. All right. The only other thing I'd say, this didn't have to be software industry. I could have just told you the Google beta is 1.2 with this DD ratio and software rate, and you would have got an unlevered Google beta and then plugged it in for the project. All right, so I could have done it that way. Again, it's just, question is, where do you get the beta? It's just, often you'll use your own firm's beta instead of an industry. So this is it. So let me take a look at the assignments. We have 5 minutes. Let's see if we have enough to do the assignments. Let me see if there's anything I should cover. So here's the last assignment. Well, 9, 10, and 11. All right. Walmart is considering the purchasing a discount rate or discount retail chain in Brazil. Okay. What is Walmart's current WACC? I think that's just the simple formula, right? I first need to calculate cost of equity using Walmart's beta. So I'm just going to take the market risk-free rate, which was given up here, 3%, plus the Walmart's beta times market risk premium. That'll give me a cost of equity. Yeah, it's given right here, market risk premium, 4.5. So that'll give me, then also, remember to do the conversion. DDE ratio is not debt percent. So to calculate WACC, I need the debt percent and the equity percent. So I'll take my DDE ratio, 0.2 over 1.2. That'll give me a percent. And then I'll calculate WACC. Now, if they want to do this venture in Brazil and it's going to have a little more debt, what I'm going to do is I'm going to take this beta, I'm going to unlever it using this tax rate and DD ratio. I'm giving you the formula, it's in the video. That'll tell me Walmart's beta if they had no debt. And then I'm going to lever it up based on these two numbers, and then just calculate the WACC again. Except when I'm done, I'm going to add 4% to it, the difference between Brazilian rates and U.S. rates. That's the standard way to look at this. You okay with this one? Okay. These are cash flows in real. You don't have this one, I'm giving you the cash flow line. I'm not actually giving you the revenue and expense. This is the cash flow in real today, cash flow in real next year, then it grows at 20% for a few years and then 3% forever. you're going to use the current real cash flow today, and you can convert that at today's spot rate, 4-to-1. You're then going to forecast exchange rates for the next 5 years based on these two interest rates. And then you're going to convert these real cash flows using those exchange rates. So now you're going to have real cash flows for the next 5 years, convert it back to dollars. Then you're going to use my growth perpetuity formula by taking the year 6 cash flow over R minus G and add that into the year 5 cash flow and calculate the NPV. So it's really just doing the very last rows of the other spreadsheet. All right, where that one where I put in that growth perpetuity. The last problem is a little bit closer to the hard one I just looked over. This is one where you have Chinese Capex. You're going to convert that back to the dollar and get the depreciation schedule. And we got Japanese and Chinese revenues. So this is going to look a lot like the one I just did. Except you're going to do it.
I was hoping we were going to work on that together.
The only thing I'm making it easier for, we will after you hand it in. The only thing it's, we'll work on it together at, two Fridays from now at 1:35. The only thing that makes it easier is I punt on the discount rate and I just give it to you. So it's just the cash flows. All right, so this one's just the cash flows. This one's just the discount rate. And this one is doing a growth perpetuity of cash flows. This one does do an EBITDA multiple. So at the end of 15 years, it's worth 15 times EBITDA. All right. So I know this is a stretch problem. I know it's unfair to make you expect you to remember stuff from a year ago. But I think it's kind of an interest, I think it's worth an attempt to try to do it. And we'll all learn together when we get back together. All right. Because in the real world, this is what it is, right? You're thrown in a project, you're doing a national project. My course is now 5 years in the rearview mirror, and you're trying to put some crap together, right? This is only 1 year in the rearview mirror, and it means nothing. It's a quiz, it's an assignment grade, right? So I want to see if you can do it.
Yep.
All right. So that's what's that? It'll just be due by 1:30 and 2 Fridays from now. These 10 problems. All right. You're going to find the first 9 are really easy. It's the last 2 you might struggle on. All right. So, next week, let's take a look. What's going on here? You also have something else due next week, unfortunately. That is... So we're going to do that problem set. It's just going to be that one. It says topics 1 through 3, but it's one worksheet. I'll do a lecture on transaction and translation exposure after that. That'll take about an hour. And then we'll do the EAS case. This is a case in which a company is trying to determine discount rates across the globe and how to adjust them. So it's really a whack case. And I'll just give you a hint what it's all about. They've determined that they're doing business all over the globe, and they should probably think about using discount rates for different areas because different areas are riskier. So what they've determined is different places they operate have different betas because they're in different business segments, and different places they operate have different sovereign risk premiums, and different places they operate are going to be financed using a different D/E ratio. So it's really just kind of setting up a spreadsheet and trying to figure out if we do this power plant in Brazil, we should demand this rate. But if we do this this plant in Argentina, it should be this rate, but China should be this rate. And that's what it is. It's trying to adjust your international projects and determine how to get an appropriate required rate of return for each one of them. So it's just kind of an exercise in trying to get whack across the globe. And it's a good case study of how a company imploded because they weren't doing it right at the beginning. All right? And so I know this is a finance class. It seems like a really highly technical finance class, but this is something the CEO should have known. They should have had the red flags when they were using one discount rate to apply to Indiana and India and Nigeria all have the same discount rate. And that caused this firm to implode. So that's the kind of takeaway. I know it's finance, but as executives and in goals of many of you to be CEOs, you should understand what the risks are of not accounting for these risks. All right. See ya. I'm on 16. All right, see you in 2 weeks.